Welcome. Today, we're going to pull back the curtain on something that pretty much underpins our entire modern world, a financial tool that literally turns chaos into predictability. We're talking about insurance.
So let's just start with a really big question. Think about a risk that's so huge it could wipe you out completely. A house fire, a massive lawsuit, maybe a whole shipping container full of goods just gone. Now, what if you could take that terrifying, unknown threat and just magically transform it into a small, regular, totally predictable payment? Well, that right there, that's the core promise of insurance.
But, to really get why the solution is so brilliant, we have to first understand the problem it's solving. And that entire problem boils down to one single, powerful word: risk. At its heart, risk is just the uncertainty that something bad is going to happen. It's not the bad thing itself, but the possibility of it. And believe me, that uncertainty isn't just some abstract idea. It has very, very real effects on all of us. Think about it. If we didn't have a way to manage risk, every single one of us would need to hoard a huge pile of cash just in case disaster strikes. All that money would just be sitting there, not being used for growth or investment. And whole industries might not even exist because people would be too scared to take the necessary chances. But maybe the biggest thing, we'd all be living with this constant, nagging worry and fear about what might happen. So clearly, we needed a better way. And the idea that changed everything was actually incredibly simple and, frankly, genius. Pooling the risk together. Okay, so pooling is the engine that makes insurance work. Instead of one person facing, say, a 1 in 1,000 chance of $1 million disaster all on their own, 1,000 people get together. They all agree to share the burden. That way, the massive, terrifying loss for one person gets replaced by a tiny, manageable cost for everybody. It's basically the ultimate form of financial teamwork. So here's how it works in practice. First, you get a big group of people who are all worried about the same kind of thing. Let's say homeowners worried about a fire. Step 2, everybody in the group chips in a small, fixed amount, that's the premium, into one big pot of money. And third, when one of those homeowners unfortunately has a fire, that big pot of money is used to cover their catastrophic loss. See? Simple, but so powerful. And this isn't just a nice theory. It's backed by a rock-solid mathematical principle. The law of large numbers basically says that the more people you have in your pool, the closer your actual losses will get to what you predicted they'd be. It's what allows insurers to forecast with surprising accuracy how much money they'll need to pay out, which makes the whole system work. It's the magic behind the machine. So we've got the math down, but how do you actually turn that concept into a functioning real-world industry? Let's take a look under the hood of the insurance machine. Right, and this leads to a super important question. If you just let anyone into the pool and charge them all the same average price, what's to stop only the riskiest people from signing up? The folks who are most likely to have a claim. If that happens, all your math gets thrown out the window and the whole pool goes bankrupt. The system needs a gatekeeper. And that gatekeeper is called an underwriter. Underwriting is this absolutely critical process of looking at each person or business that wants to join the pool and figuring out exactly how much risk they're bringing with them. The underwriter's job is to make sure the price you pay, your premium, is a fair price for your specific level of risk. This is a perfect example of how it works in the real world. Let's take marine insurance, one of the oldest kinds there is. An underwriter doesn't just see a ship. No way. They ask detailed questions. What kind of vessel is it? A tanker has totally different risks than a cargo ship. Is the vessel chartered? If so, we need to check out the person chartering it. Is it properly certified for safety? Every single answer helps them build a precise picture of the risk so they can set the right price. Now, underwriters are always fighting a battle on two fronts. The first one we just talked about, adverse selection. That's the problem of attracting way too many high-risk people. The second one is a bit different. It's called moral hazard. This is the risk that once somebody has insurance, they might get a little careless or even dishonest because, hey, they know they have a safety net. A good underwriter has to account for both of these human behaviors. So once you perfect this system of pooling risk and careful underwriting, you can apply it to almost anything. And that has created this incredible world of coverage that touches nearly every part of modern life. We already saw marine insurance, right? It started with protecting ships from things like pirates, and now it manages the unbelievably complex supply chain risks for cargo that's shipped all over the globe. Then you've got liability insurance. Now, this one's interesting. It doesn't protect your property. It protects you if your actions accidentally cause harm to someone else or to their property. And this whole area of insurance is built on a really fundamental legal idea called the duty of care, which is summed up perfectly in this quote. It basically says we all have a responsibility to not be negligent and hurt the people around us. Liability insurance is the backstop for when we fail in that duty. This protection even goes all the way up into the boardroom. D&O insurance, as it's called, covers company leaders if they get sued for making bad decisions or so-called wrongful acts. It protects them from being personally bankrupted for choices they made while running the company. But here's the thing. The world of risk never, ever stands still. As our society changes, the tools we use to manage all that uncertainty have to change right along with it. So let's look at what's next. And this points to a massive change in thinking for the entire industry. For a long time, insurance was just about paying for the damage after it happened. The new goal? To be a proactive partner and help prevent the bad thing from ever happening at all. It's a total game changer.
And of course, technology is what's making this all possible. AI is allowing insurers to create hyper-personalized insurance products using real-time data to give you advice and services that are perfectly tailored to you right when you need them.
And this kind of innovation is absolutely vital because the risks we're facing now are on a whole different level. The industry is trying to figure out how to handle massive existential threats like climate change, the explosion of cybercrime, and something called systemic risk, where our interconnected world means that one failure can trigger a disastrous domino effect. So, it all comes full circle. That core idea of insurance, sharing risk to tame uncertainty, it's more important now than it has ever been. But as the very nature of uncertainty evolves, the real question for all of us is, how will this powerful tool have to adapt to keep us safe in the world of tomorrow?